Welcome back. I'm Rebecca Wallenfelsz, a partner in the Trust and Estates Group at Chapman and Cutler. With me on this series again is Mike Jankowske. Mike is the president of the Hamelind Group, which provides plan giving resources and strategies to professional advisors, donors, and non-for-profits. Mike and I have been doing a series of videos where we talk about tax diversification. And in each of the videos, we've been tackling a different subcategory or bucket, as Mike likes to call it, of an asset or property or concept that falls within this parameter of tax diversification. So today, the particular bucket we're going to talk about is trusts, which as a trust lawyer, right, speaks to my heart. But Mike, this is sounds like an atypical topic for a tax diversification bucket, to have a bucket called trust. So why don't you explain to our audience a little bit of like tax diversification and why they want to think about this as one of the tax buckets.
Well, I'm glad you've taken over the term bucket versus categories. I cross over. It looks like you've taken ownership of buckets. But this all goes back to, and I just want to make sure people understand, I didn't invent the concept of tax diversification. If you Google tax diversification today, what you're going to see is a three-pronged bucket or category that falls under specifically investments and how you could be more diversified from a tax perspective, only from investments. I found that too narrow. So what I started thinking about is how could I turn around and talk about tax diversification from a total wealth perspective.
Yeah.
And my last category I added, or bucket, was when I remember clearly that when the estate tax law changes in the year where I think the amount you could pass to the next generation was 600,000 and they cranked it up to 5 million. I remember clearly having a lunch with an estate planning attorney, not Rebecca, because she's on top of this stuff. Okay. He was bemoaning his fate. He didn't know what he was going to do in his practice. And I said, well, wait a minute. And I had a revelation at the same time I said this. It's not just about saving estate taxes, which trust can do because you freeze assets, you move over to the trust. It's about how you reduce income taxes during a client's lifetime and for the next generation. And all of a sudden he had an aha moment at the same time I did. After I got done with lunch, he changed his practice. And when I got back home from the lunch, I started working through what can I do in using trust besides charitable trusts, which I mentioned in a prior segment under tax strategies. So it's an interesting story that led me to more design and building out the concept. And this is critically important when you start having higher wealth levels. And I won't say higher and define what that means. It's all relative to a person's circumstances.
Yeah, that's great. And so what do people think about when they look at this as a tax category? Like, who is this tax category appropriate for besides someone who just of higher wealth levels?
Well, the interesting thing is I almost call this category a tax diversification strategy inside of a tax bucket. And the reason for that is it's how you can be tactful in the trust world. And I need to define so everybody understands this is not something where you create a revocable living trust. You have actually parked assets, businesses, whatever the case may be, real estate, into a new entity you've created called another family member, where a trustee controls the trust. And it's typically not the person, but it could be if done right. But then there's components. There's the income beneficiary of the trust. There's the remainder beneficiary of the trust. It's, who's going to get the money when the person that designed the trust passes away, typically, or persons. And there's the grantor / trustee, which could be one or two different people. So that's important to note. And then now you think about this. If part of the strategy we've talked about in other segments talked about reducing income in a year, when you're going to do Roth conversion, or in any year we're going to transition some money over from, another tax category to a more favorable tax category, one income reduction strategy is to transfer assets over to an irrevocable trust. Why? There's one of two ways you get taxed for an irrevocable trust. You either have the trust pay the income taxes, or you have the income beneficiaries, should they get the money, who get taxed on the income. So that's the lead in to what happens there, because the first tactic as to why trusts make sense from an income tax perspective is you don't report any income that the trust creates. It's either taxed at the trust level, or if you're the income beneficiary of the trust, all bets are off. You didn't do anything to help yourself. So that's kind of like the starting point.
Yeah, yeah, and that's a great point, because as an estate planner, right, we often use trusts like this as reducing estate taxes, or, for family planning purposes, to get the assets down to another generation or down to different people, and to reduce the estate tax liability or the gift tax liability. But tactically, right, you do want to be thoughtful about, when I create that kind of trust, I have usually, and the way I describe it to clients is, I have some income tax choices to make. And some of that can go into, it becomes how I structure the trust, because I can set this trust up so that the grantor creator is taxed on the trust income and earnings. The trust itself is taxed, right, on there, or the beneficiary is. And it all goes into the, what planning strategy am I employing, and being thoughtful about how I set this up. Would I want the grantor to be taxed? In your situation, the way you're describing the trust in using this, I wouldn't want the grantor. If I'm using this to reduce the grantor's income tax liability, I wouldn't want that. But then my choices become the trust as a separate, taxpayer. It pays the tax liability, or someone else who's the beneficiary, but then I've got to make distributions to that person or give them certain rights so that they pay the income tax liability on the trust earnings.
I sense a conflict in Rebecca's brain, because she told us in other videos that her favorite category were tax exempts. Her behavior and enthusiasm is still falling into the trust category. So maybe you just have to split your passion between tax exempts and trusts. I think that's important.
Yeah.
But it's important to know, this is the cool part. First, there's the idea that you can, and again, it would be financial income tax suicide to actually implement income back to the grantor who's trying to do a reduction of reportable income. But with that being said, you don't want to get slaughtered on income taxes with the other methodologies for creating income. So for example, by design, if family members or your favorite person here that's become your friend, if you're wealthy, okay, if we're in a lower tax bracket than the grantor of the trust, it's almost nonsensical not to distribute out to them based upon need, okay, and the proper rules of the trust, because at least you're going to get a reduction in income taxes on top of the fact you're not going to report the income for yourself on this world. And that's an area where a lot of people at certain wealth levels and above, and you don't have to be super wealthy to do this. A lot of people make gifts to kids and family members and friends. In lieu of making gifts, distribute money from a trust. Let them bear some of the burden of some of the taxes. And you can even supersize what you distribute to net out what you normally do in a gift. But if you gift anyway, there's going to be some capital gain issues if you liquidate whatever the gift is to begin with. But that's one tactic that you need to look at. If you can design the trust and have the income beneficiaries be such where you've recognized they're in a lower tax bracket than the person that created the trust, it's relatively easy to turn on or off a switch to pay them as needed. Now, with that being said, what happens if you don't turn on the switch? This is the problem, because Rebecca will tell you quite emphatically that trust income tax rates are the highest in this country.
Yeah, trusts have very compressed tax rates. So I, as a taxpayer, I think I need like a little over $400,000, and then I'm in the top tax bracket. Trusts reach that at just over $14,000 of income.
Yeah, so you don't want to do that, because you're going to look at what the trust pays in income taxes, which brings us to an interesting concept of the tax diversification within this tax category. How can we design a way to not give up the overall return of the assets you have in a trust category, while yet at the same time have options to distribute under tax favored methods? Now, it's all about thinking about this tax category in the composite. So for example, for years, people have argued with me, why would I put money in tax exempts in the tax exempt category? I'll sacrifice return. And my response always been, if we have a large Roth we created, we can blend and be more aggressive in the Roth to counteract that little bit loss of return in the tax exempt and still get the overall return you want. Well, the same concept applies in the trust world. Okay. What if, for example, you had a circumstance where you design a portfolio, and this is just one example, there's many of them. You design a portfolio where you have tax exempts inside of the trust. And let's say, for example, you purchase a life insurance policy that's a variable life policy. We can invest in equities inside of the life insurance, and net of the cost of the insurance, you can have a higher return where you blend the tax exempt return with the insurance return. You're pretty much whole. But with that being said, when you die with the life insurance, your return escalates because you're going to get a larger amount of money for your family. So that has to be equated to what might come back to the family in a higher overall return over time. And the fact that that money coming out of the life insurance is tax-free.
Right.
So if you have those two, for example, as one example, you could let that money sit in trust. And how much does a trust pay in income taxes on tax exempts, Rebecca?
Well, it depends on what state it's in, but it's not going to pay anything to federal.
No,
and then,
right.
And then it's just what state you're in, and does that state tax those tax exempts?
Exactly. So if you combine the two, the trust would have very little taxable income. But by the way, trusts do have expenses. So if you have a reportable income, you can net out. You have to net out any expenses against trust income anyway to create what they call net distributable income. So the bottom line is, you can, if you understand how to manage tax diversification from an investment perspective, but not just a normal portfolio. Inside of the trust, there's more you can do. Now, what if you want to distribute? Okay, you could take money from the tax exempt bucket within the bucket, and then you can distribute it out as long as the trust is designed to do that, right?
Yep.
You could take a withdrawal from the insurance, which if you do it the way I'm suggesting, it's going to become reportable income. But if you have a blend between reportable income and tax-free and you distribute it out, it's still going to be a better deal than what happens if the grantor person made a gift themselves. So look at some of the examples of how you could tweak this sixth category or bucket to not only reduce the tax liability on the grantor or the person that's trying to create a tax diversified buckets of money, but yet creates extra benefits that fits into their estate plan. That's the part. And again, there's so many nuances you can do with this. Unfortunately, not too many people understand what irrevocable trusts are all about. So they're like, if they don't understand, even wealthy people don't really understand it. If they could be educated about what's possible and have it validated in a planning tool to demonstrate the advantages, at least they should investigate it. And God forbid they should have some charitable trust created inside of an irrevocable trust, which you can argue whether it falls under tax strategies or tax shelters versus the trust category, for example.
They're both, yeah. And this is wonderful, because I don't think enough people think about the income tax consequences of trust, as well as just the use of trust to reduce income tax liability. I think many people start thinking about trust and the rate of tax that trusts pay, and are like, oh, trusts aren't a good vehicle to think of, as a income tax reduction. But what you've pointed out is, when we're doing an overall wealth analysis and comparison, moving income tax liability from someone who's already in a high tax bracket into a trust, maybe you end up paying the same tax rate, but you're taking it out of the grantor's income tax return. Let alone the ability to maybe move that money down to someone who was in a lower income tax bracket. And so I gained some income tax efficiency there. And then if I'm really smart and maybe even flexible, you can also play with state income tax rules, because states have different rules for what makes a trust taxable in that state and the jurisdiction. And so I can have a trust, if I'm not thoughtful about it, that actually has to file tax returns in a couple of different jurisdictions, or it might have Zero, because no state claims it as a resident trust, and so I pay no state income taxes.
Yeah, there are certain states that you could do that in, but the purpose of this is not to get into the rabbit hole. And I
Nope,
know Rebecca couldn't help herself. I
I
will
couldn't.
ask Rebecca a question as part of finishing up this segment before we introduce what were the exciting next parts we're going to be doing in this video series. Loans against the trust, not loans. The trustee decides to loan money to an
Yep.
income beneficiary. Classic example is college. What happens income tax wise there?
So for there, it's just a loan, right? And so then it becomes a question of whether that loan charges interest or not.
Okay. So there's some things you can play with. There are so many nuances. Rebecca looks like she
Mhm.
wants to keep going and going and
Right.
going to give you more closure, or excuse me, not closure, more of an opportunity to want to investigate because that's her space. But again, we've given her a little bit of religion and income tax planning, although she had it already. Okay. And I still need to debate with her whether or not the tax exempt category or the trust is her favorite one.
Mm.
But that's not intended for this video. This will be an off video discussion. So,
Well, thank you, Mike, actually, for kind of this really good series. First of all, talking about all these buckets, including the trust bucket. I'll let people decide which one is my favorite. But we also are going to be doing additional videos. We're not going to stop now that we've talked about our 6 tax categories, right? In our next video, we're going to be discussing or doing a demo of a planning tool that kind of walks through some of a particular tax strategy, as well as doing some additional videos where we maybe share some more specifics about tax strategies.
yeah, and it's interesting because I think it's important because I'm sure somebody's going to view these videos and go, well, that sounds nice, but it doesn't apply to me. Or the other question is, how in the world does it apply to me? I'm curious. Unfortunately, when you go back to a lot of professionals, and this is attorneys included, no offense, along with the CPAs, financial advisors, you name it, they don't have the planning tool capability in some instances or the understanding of some of the concepts. So you need to find a way that a person can have something to get them, for lack of a better description, juiced up a little bit or acknowledging or understanding there's perhaps some opportunity here based on their circumstances. And storytelling will do a lot to be able to do that. So if I show in a subsequent video a planning tool demonstration that shows doing a Roth conversion and offsetting the taxes and what it means for you short-term, medium, and long-term, that's going to be an aha moment for anybody that's even contemplating that as a possibility as part of this tax diversification strategy. And we've done, we meaning in my prior life, we had an association, I still do, with the National Community Foundation that has a whole slew of white papers that I'm redesigning to integrate into tax diversification that talk about all kinds of cool charitable things you could do and accomplish tax diversification. So stay tuned for these white papers / demos.
Wonderful. I'm looking forward to those. Any last comments or thoughts for today's video?
If I were trying to be in a funny mood today, which I am already appearing to be, I would try to find some way that Chapman and Cutler could probably do a poll among all the clients and professionals who see this to see whether or not she would opt into going with the tax exempt category as her favorite or the trust category. But other than that, I'm really appreciative of the fact that we're doing this because it's important that professionals, it's important to not-for-profits, for example, who have tremendous opportunities out of getting people to do tax diversification. And last but not least, clients / donors can create more opportunities to diversify from a tax perspective. But one of the byproducts is going to be they're going to transform what I call involuntary philanthropy into voluntary philanthropy. We have another bucket, which is not part of the, well, maybe it is, under the tax shelter category, a donor advised fund or a foundation could be in that category where they have a much larger scale bucket of money that they can apply and grant back to charities to have more impact to help that charity.
Yep. Yep. That's wonderful. I'm all in favor of that.